Anyways, so this week, and hi, welcome everyone again to the experiment. So this week I thought we'd chat a little bit about comparing notes on a topic I know is near and dear to your heart, which is as a product leader, being cognizant of finances, and not just finances on the level of P&L, but finances on the level of funding strategy, corporate development, thinking through kind of how does that business value represented in the P&L actually convert into enterprise value and shareholder value. And since we're going through this rarely, like a somewhat rare downswing in the tech market and in risk assets, that every person, whether it's trying to find a new job, trying to switch lanes on their career, or even just like keeping their company afloat, I thought we could swap a couple of stories on leadership experiences through financial turbulence. Because, we're both old.
Been through a few of those.
Been through a few of those, and I think that's kind of the one comfort I can bring to the youngins whenever I help them, is to say, like, look, it's not you, it's the market. And second of all, these come and they go. Sometimes they last for longer. Sometimes they come and go a little quicker.
Right.
But, I joined the workforce when the dot-com boom was at its highest and, saw the bust firsthand. We've both easily been through the Great Recession and all the fun stuff that happened there.
Yep.
And so now the venture winter of, 22, 23, 24, nothing new to us, right?
Right.
So I like the format you brought last week of let's swap some stories rather than speak in abstractions. So I can start.
Yeah, please do.
I do, obviously my last couple of years at WorkStep are like fresh in my mind. And it's such a funny, almost like caricature level journey in the last couple of years, where obviously we've seen the venture faucets get turned off almost completely. You look at any of the stats of how many seed rounds, how many A rounds, how many B rounds have happened, in 20, 21, 22, and you just, the fall off the cliff is crazy.
Yeah.
And you look at venture fund performance and like, it's all, down rounds and flat rounds and just nobody's doing well. So anyway, kind of the underpinnings of the WorkStep journey was funny because I'm still trying to figure out in my head whether the founder is like the biggest business genius of the 21st century, having raised a really beefy round just before things shut down, or if he just kind of stumbled upon semi-luckily and like raising a little earlier than he really needed. But it was funny, we came into this era well capitalized in a time where like everybody was trying to find pennies in their couch cushions to keep the lights on.
Yep.
And we found ourselves in a place where we had a rock solid growth engine product and, not tons, but like plenty of money in the bank to kind of keep trucking along. But at the same time, needing to lead with this constant nagging knowledge that the ATM is closed. Nobody knows when the ATM opens again. Like, risk money is just not there. And even if it is, it's under significantly harsher terms, crazy compressed revenue multiples. And of course, the downside of having raised a round at the very end of the, crazy period was that, that was on very favorable terms. So you almost get into a place where to not look like a failure, you have to not just be superhuman, you have to be like hyperhuman. And so anyway, I'm trying to kind of, let me keep this shorter. It was such an interesting time of leading a company because, of course, I've got ages and ages of experience leading through zero interest rate policy, money is free, just keep hiring, just keep building. And all of a sudden you find yourself in an environment where everything's great from like a pure product lens. Retention's great. Growth is working. Everything's just kind of, customer satisfaction is great. We're creating great value. But the gun is always to your head on like, it's not enough to be great. You have to be just incredible. And I found that pretty exciting. And I don't know if that maps well to your experiences in like I feel like whenever you talk about your old stories and you talk about kind of the moments you're most proud of, it almost feels like you operated with a gun to your head and like needing to pull like a rabbit out of a hat turnaround story. Are you a glutton for pressure, Giff?
I definitely am a bit of a moth to a flame. It's true. I'm not afraid of challenging circumstances, and I guess although what's the honest answer is that I've gone into a lot of companies where the story was amazing, thinking that okay, this one's gonna be this one's gonna be the easier up and to the right, and then boop, nope, not this time around. And then we hit headwinds, and sometimes they are external, like a financial crisis, and sometimes they are that what looked like product market fit starts to evaporate. Either when you're trying to move into a new market, or you're trying to really expand your market, but like everything seemed to be hunky dory, and then all of a sudden it's not anymore. Yeah, and it's very much it's a tricky environment. You know, what the one obvious thing that I've learned over the time is to be really clearly aligned with the CEO, the CFO, and the board on the financial goals that are truly happening right now, that we truly care about right now. And when I say truly, it means you've actually got to dig in a little bit, because everyone always loves to talk about revenue growth. And in frothy times, that is the name of the game. Grow, 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 right? I mean, we talk about growth, scale up stories. That is what we're talking about, right? But, you know, like when the 2007, 2008 crisis hit, and Sequoia put out that very famous presentation now that like opened up with RIP, with the tombstone, and everyone was like, it's over. Of course, it wasn't over. You know, everything passes, and everyone didn't die. A lot of startups did, but not everyone died, and a lot of people thrived in that moment, and growth came back again. But I think there's a lot of contexts where the story is growth, but actually you need to really pay attention to how much is our gross margin really important, and how much is the bottom line really important. Like, are we going to try to grow our way through this? And that's just the story. And yeah, you've got to put, Herculean effort into that. Or is it actually we gotta continue growing, but we gotta get to break even at the same time? And everyone's got to do more with less. And the interesting thing actually is that you can do more with less. It's amazing how much more you can do with less, partially because of pressure, but also because fewer humans is more efficient.
Yeah, absolutely. I mean, that's kind of I mean, there's a downside to it. Obviously, there's been a couple of things influencing the market and the industry right now, starting from like the weirdness at Twitter, where like I feel like Elon just kind of like unclogged the ketchup bottle on a lot of somewhat toxic behavior, where like suddenly all the CEOs and leaders out there were like, hey, you can fire half your company and keep trucking. And then, of course, the impact of AI on productivity during a time of like extreme scarcity,
Right.
just makes for a really interesting financial context to lead through. But to your point, it's not all for naught, because I think we've all seen the downsides of the hire anybody with a pulse, just grow by virtue of growing headcount at any cost, whether it's like just the sheer complexity of more humans, meaning more connections, meaning more complexity, or just the fact that when you're hiring, a culture, somewhat of a culture of mediocrity is almost inevitable to follow, right? Because it becomes really hard to get rid of people when your goal is to just like staff up, staff up, staff up.
Who your investors are really matters during this time. You know, in the 2007, 2008 crisis, I was coming out of doing a virtual worlds and games software startup. And there was sort of, now metaverse has been sort of back. We'll see where it goes this time around, but it was pretty hot at that time too. And the financial crisis hit. We had been growing really well, and that just like put the skids on everything. We had, as one of our investors, instead of raising from a traditional venture capital firm, we had raised from a corporate VC, a large media company, and they were super excited about the strategic alignment of where these new forms of entertainment in terms of virtual worlds and a metaverse and all that stuff were going. And so, they put quite a few $1 million in the company, had a board seat and things like that. And what was so interesting for me in that scenario was realizing that when the time came for the company to be thinking about survival, a venture capitalist would have been saying, I want you to survive. We're not putting more money in this thing right now, and you've got to live to see another day. So tighten that belt and focus on survival. But I still need this vision to happen. I still need growth to happen, right? I still need this to be an exciting company because at the end of the day, I need my 10x multiple, right? It's not always 10x, but whatever. With the corporate investor, it was actually an executive who was totally focused on their own career survival, because they weren't a fund that needed to go raise the next fund from new LPs and have this exciting outcome. That's not why the corporate, the big media company put money in the first place. They didn't want a failure on their resume. So they put a straitjacket around the company and had us do like the safest, dumbest stuff we could possibly do, which basically just like neutered the company and put it into a death spiral because no one wanted to be at this company because there was no future. And it was like driving us more towards services revenue rather than product revenue, which of course where the valuation multiples were much lower. And of course, at a time when it was hard to get services clients anyway because everyone was tightening up. So the whole thing was just dumb. And that was like, oh, we had the wrong investor. And then I fast forward, to another situation where, we'd gone through a Series D and like things had been growing, and all of a sudden realized, oh, there's actually we've been forcing growth and there's some fundamental flaws in this business model that we need to solve. And the Series D investor who, talk like, claim they were a duck, like a venture capital, but these later stage quote unquote VCs don't like risk, right? They want coin operated machines. And so all of a sudden when risk emerged that hadn't been in the fundraising process, they sort of waded in and they tried to like dump the growth playbook on the company. Here's we're going to fix up go to market. We're going to put more money in over here. You're going to be spending money on salespeople. And we're basically saying like, there's actually a problem with some of the market that we've chosen. There's a problem with some of the revenue lines, and there's a problem with how we've chosen to make money. That's actually putting a cork, it's like putting a cap on the growth potential. But it was really hard for this investor to see it. And that led to some very feisty battles between that investor and the executive team, because there was like the kind of investor, and we did have some like typical VCs who were really great partners to the company during that, but the new money into the company, and now the largest amount of money, because it was a big check that went into the money, was like it was oil and water. And that led to a very, very, like, it just made navigating a tough time so much harder. And there's plenty of stories in that.
Well, it's funny because one thing you mentioned is really important there, which is not just the right investor is critical, but also knowing what kind of investors you have as a leader. And I found that to be pretty rare and I don't know if it's like a push or a pull problem, but oftentimes you have executive teams that are a little removed from not only the board, but also like the non-board member investors who at the end of the day do govern a lot of the strategic choices of like, are we playing go big or go home, or are we playing kind of, safe bets? Are we, just what's the name of the game, especially given the financial circumstances? And it's really hard to make great leadership choices or even feel heard when you're playing checkers and the game is actually chess, but the CEO for some reason chooses not to reveal that. And it just seems so common in these situations where the leaders don't even always know, or if they know, they don't acknowledge what type of game the powers that be want you to play. And it
totally
gets
agree.
all sorts of messy when that happens. Um,
Actually, this is so important, and it's so black box to a lot of people that you know the fourth class of my finance class for product leaders is we spend a huge amount of time saying, here are the different classes of owners, and here's what they care about, and here's their economics, so that you know what you're walking into when you're an executive joining a company, and you have a better sense of when the winds change of how they might react, that will keep you aligned as opposed to misaligned.
yeah, it's funny because you mentioned kind of the later stage venture funds, which is almost an oxymoron, right? Because
Yep.
like the whole point of like a Series D level venture fund doesn't have a high risk appetite, which is like oxymoronic because venture funds by definition are like the riskiest asset class. But somebody once described kind of the journey of a company and the funding as like almost a supply chain for public markets. Like the purpose of venture funds is to be a supply chain to deliver product for public markets. It's like an interesting way to look at it, where like the final mile is pretty risk free. Like the last stages before an IPO, which is basically bringing the product, meaning the financial asset, to the public market. And then you look at like upstream in the supply chain, of course, is where all the like really high risk is. Like there's no revenue, there's no proof of the business model, there's just a hunch and a, you know, some sort of like sketched out TAM. But then when you go down that road, that risk appetite significantly reduces and the playbook becomes just like greasing the wheels of growth.
Although you know with me that it's not risk free at all. Actually, that could be a very fraught moment of trying to go public, and not just in financial crisis. I mean, I was with a company that was one of the very last companies to go public in the dot-com era. Like we made it out. Of course, we were all locked up, and like 2 weeks later, it all really went to shit. Um, but even, think about, as you know, right? I was an executive at Meetup. We were wholly owned by WeWork. Um, WeWork, thrived in this environment where you had a lot of private money, huge amounts of private money being poured into companies, and that led to some distortions of behavior. It led to pushing the reality check of how the public markets are going to view a company out. And so there was WeWork thinking that they were worth 85 billion dollars.
Yep.
And the public markets are like, no, you're worth 15.
Yep.
Which is still a big company, but it ain't 85.
Yep.
And that brutal reality check over a span of months led to a rather colorful time in my career.
I do remember that. That was an interesting time. And honestly, like that same time, roughly around the same time is like when the pandemic struck. And that's like I kind of teed this up as like, let's talk about the challenging times. The pandemic was the weirdest time because I was working at Teachable, which of course is like a commerce platform for people building online businesses. And it was an absolute boom time for Teachable's core business. But at the same time, like it's weird. It's easy to operate when you know if it's headwinds or tailwinds. But when you've got true turbulence, like tailwinds and headwinds and sidewinds and everything at once, holy moly, your head goes on a swivel. And like, for example, for us, it was very clear from like a month into the pandemic that this is like a once in a generation opportunity. And it's horrible to talk about such a freaking plague on humanity as an opportunity, but it was like the road was open for our category of companies. And it was super, well, first of all, just like trying to hold on as like the rocket takes off, but at the same time trying to like look at what the other companies were doing, and of course like analyzing them a little later as we get some of their insights on, like some companies were pouring like 150% of revenue on sales and marketing, which sounds wacko, but at the same time when you're presented with a gold rush market, might be the right thing to do to capture market. But and then the other part of like, as the IPO market started crashing, was exactly the time when all of these creator economy companies were like ramping up for IPO. Some of them made it, some of them didn't. And you look at, I mean, for example, Thinkific that just made it before the market blew up, but you look at their market cap, like I think they're still somewhere in the minus 95 range, like, and hasn't recovered at all because the, COVID hangover for the creator economy platform business was pretty harsh when it started.
Well, and yeah, once you become a sick publicly traded company, it could be really hard to recover from that.
Yeah.
More often than not, you end up being privatized and patched up there. But yeah, there's this is a good topic, I think, for us to dig into. There's a lot of stories and a lot of issues around this, not only these macro concepts that we've been talking about today, but also just like how you lead through these moments and some of the challenges, specific challenges that we faced trying to lead in moments like this. So I think we should dig into this one for a
Do
few
it.
weeks.
I mean, I've heard you like this topic so much, you've made a course on it. So
Yeah.
feels like there's more dry gunpowder there.
There's no shortage, I think, on this particular one. And the timing of in terms of what people are going through right now, I think is relevant.
Yeah. Cool. Let's do it. Let's come back to this topic.
Okay, good. All right. Well, thanks for another interesting week, Tommy.
As always.